and welcome to Arnerich Massena's second quarter 2020 MarketCast. This past quarter, we have faced global challenges that are truly unprecedented. When we are faced with major crises such as we're seeing today, we believe it's important to recognize that they can also be an opportunity. We've been shaken out of our normalcy bias and more or less forced to take a deeper look at the world around us. And there is no better time to make the changes we want to see in the world. And we think that with the unprecedented challenges, there are unprecedented opportunities as well. We'd like to thank you, our clients, for your continued trust in us and our stewardship as we work to discover those opportunities and help you build your legacy and advance your mission. We look forward to continuing to help you find strategic growth opportunities while aligning your portfolios with your personal values in order to build a more just, more compassionate, and a healthier world for all of us. In this MarketCast, co-CIO and co-Chief Investment Officer Bryan Shipley will review the past quarter and the current market environment. And then I will outline how our client portfolios are currently positioned and some of the ideas we may be implementing in the coming months.
Thank you, Melody. Over the years, we've always believed in taking a steady approach to investing through periods of market volatility. We do this because history has shown that many of the best periods for stocks come immediately after some of the worst, which makes it nearly impossible to time the market day to day or even quarter to quarter. And this was certainly the case in the first and second quarters of this year, where after the first quarter shock, stocks came roaring back in the second quarter with double-digit gains. For the S&P 500 index, it was the best quarter in more than 20 years. And throughout this volatile period, traditional safe haven investments such as U.S. bonds, treasury bills, and the dollar held up really well, attracting investors and preserving capital. So with all this extraordinary volatility comes a lot of questions. Where is the economy headed? Where are markets headed? And are we seeing a disconnect between the U.S. economy and its stock market? So let's start with a look at the economy. The chart in front of you shows how the pandemic has drastically rearranged our spending habits. First, at the top, we can see that balances are rising in money market funds, a sign that consumers have been tightening their belts and saving more for a rainy day. But they've also been spending more online as well as at discount stores, while traditional retail chains and department stores are down dramatically. And with the stay-at-home orders in place in many states and cities, hotels and restaurants have really struggled. From this chart, we can see that the disruption has been extraordinary, so much so that our government and monetary policymakers have had to step in with massive measures. With the U.S. economy expected to shrink 8% this year, and the world economy expected to shrink by 4.9%, governments around the world have announced $11 trillion in fiscal relief, including additional spending, loans, and guarantees. And central banks have also been bringing trillions in monetary stimulus to the table. Looking ahead to next year, the world economy is projected to grow by 5.4%, and the U.S. economy is expected to grow by 4.5%, which would only recover about half of this year's 8% projected loss. So while these measures have been helpful, they're by no means a miracle cure. And what's more, they risk fueling market bubbles and speculation. This brings us back to our original question. With the U.S. economy struggling and stocks not too far from their all-time high, is the U.S. stock market disconnecting from economic reality? In this chart, we can see the strikingly wide gap between the blue line, the S&P 500, and the red line, which represents corporate profits, which in the second quarter were projected to decline by 42%. The last time we saw a gap like this was in the early 2000s, just before the collapse of the tech bubble. So, we think that it makes sense to be cautious and selective when investing in U.S. stocks today. Another thing that we're keeping a close eye on is there appears to be some market speculation going on right now in U.S. stocks. Take, for example, Hertz, the car rental company. As you may have seen in the news in May, Hertz was unable to service its debt, so the company filed for bankruptcy. Following the filing, Hertz stock became nearly worthless because bondholders would have been paid in full plus interest before stockholders could recover any of their investment, which really seemed unlikely given that Hertz bonds were only trading at about 30 cents on the dollar. However, to the surprise of many, in the weeks following the bankruptcy filing, Hertz stock rose nearly 900% from its post-bankruptcy low price. Meanwhile, on platforms like Robinhood, which is an app-based commission-free investment platform, the number of users who owned Hertz stock skyrocketed. And curiously, several other troubled companies such as Chesapeake Energy, Whiting Petroleum, Valaris, and JCPenney have also experienced unusual price appreciation after filing for bankruptcy this quarter. Was the price of Hertz being driven to rational highs by online traders? We'll never know for sure, but certainly there appeared to be a connection. Unfortunately for many of those online traders, the rally in the bankrupt Hertz stock was brief, and the company soon gave back its gains. So, rather than trying to time frothy markets, we think it makes more sense to identify and capitalize on longer-term trends. Take, for example, the global transition to renewable energy. Bloomberg New Energy Finance projects $13.3 trillion will be invested in new power generation assets over the next 30 years, with more than nearly 3/4 of that being directed towards renewable energy. Leaning into impact themes that will have the wind behind their back over the coming decades is something that we've been building into portfolios to take advantage of through both public and private market investments. It's important to keep in mind that the United States is not expected to be the world's growth leader going forward. That means it's going to be important to invest internationally. And it's our view that despite the short-term challenges of COVID-19, emerging markets are being continually bolstered by growing domestic consumption, favorable demographic trends, and continued global integration. In fact, by 2030, we expect Asia to contribute roughly 60% of global growth, and for China to overtake the United States as the world's largest economy. What's more, this resilient economic growth isn't exclusive to Asia, as 6 African countries are among the world's 10 fastest growing economies. So now, more than ever, we're looking for international investments for long-term growth potential. So, to put all these ideas together in terms of our portfolio positioning, I'll hand it back to Melody.
Thank you, Bryan. When it comes to day-to-day market fluctuations, we tend to have a fairly steady hand. And during the first half of this year, we've held firm in most of our positions. For example, we're still leaning into international and emerging market equities. And we are also being value conscious when buying U.S. investments. In fixed income, with yields as low as they are, we're staying defensive by limiting duration and credit exposures. Looking ahead, we think that market conditions may soon become much more favorable in 2 areas: small cap stocks, which we think could outperform as the economy starts to regain its footing, and international equities, particularly the Far East, which continue to have much more attractive growth prospects relative to the developed markets and appear to be handling the containment of COVID-19 far more effectively. Now, more than ever, given the dynamic market situation, our timetable for making any tactical changes will need to be flexible. Your advisor will work closely with you to keep you informed about specific investment opportunities as they become available. Please visit us on our website at arnerichmassena.com for more information. On our blog, recent posts include a link to an article from co-CIO Bryan Shipley published in the Portland Business Journal about intentional investing, and a weekly series about helping in times of need, in which investment and philanthropic advisor Catherine Fox highlights stories of ingenuity and dedication in local Portland nonprofit organizations. Thank you for joining us today.